Hey everybody, Marty Mazur, good morning. It is the 25th of August, 2017. What you have in front of you is Monday's analysis. This is something we do at the beginning of every week. This is a look at what we think are important technical indicators applied to the market, the S&P 500 in the first line, and then the various sectors. These are ETFs, are kind of the core ETFs that we use, cyclical, then defensive, non-US, and just under defensive asset classes. I used gold and the 20-year Treasury Bond Index ETF. There's a chart that goes with each one of these, and I've shown you these charts numerous times. I'm not going to do that today. I'm just going to show you the result of each analysis or each data point. So this up here is really binary. It's a yes or a no, a plus or a minus. Is the price, for example, trading above its 50-day moving average? If it's above, it's green. If it's below, it's red. Slope of the moving average, probably, as I've said here before, the most respected long-term trend indicator out there. If it's pointing up, that tells you we're in a bullish mode. If it's pointing down, we're in a bearish mode. The moving average convergence divergence on a monthly basis has been an excellent long-term trend indicator. Like anything else, though, there are false signals. We found that if we compare it to the 200-day moving average slope, we get a better indicator. So now what we do herein is we've created our MACD 200-day moving average slope indicator. And so when they line up, we end up in a very bullish posture from a longer-term basis. So that's what this is over here. So again, applying that to each area, you see the red developing here pretty much across the board with U.S. equities. Commodities are looking a little better of late. Utilities are doing okay. Foreign still very strong as of Monday on a shorter term basis. Defensive stuff, I've been pretty bearish on bonds, as you know, if you've been watching the videos or reading the blog. Gold is kind of all over the place, very jumpy these days. Definitely gold, in my view, has been guided by fear more than anything else of late. And then below that, we have a snapshot of the current chart. This would be on Monday. You see the market breaking down below its 50-day moving average, which is reflected up in here in this red. And then the economic data that we track weekly as well. And what I'm going to do is I'm just going to scroll down and just get past the financial stress indicators here. And I think these are very important as it relates to recession risk going forward. But as importantly, how's the consumer looking? This is some pretty basic but important stuff. Businesses, what's inflation look like, and then financial stress. So if you wonder why I've been pretty sanguine, or we've been pretty sanguine here and on the blog, it relates both to the technicals and the economic backdrop. Now, what I would say here is with this kind of strength, would suggest strongly that this would be volatility to ignore, and certainly the slope and the shape and the position of the moving averages would also suggest this is volatility to ignore, despite all of the headline risk that we think is out there. So let's test this, though. It's one thing to say this is where we are, and you should feel pretty good, and of course expect volatility, as we've been warning a lot lately. But what happens when we look at these things further back? So I'm going to take you quickly through history, as pertinent a feel as we possibly can as it relates to the current state of affairs for the markets and the economy and so forth. So here is October 8th, 1998. Let me scroll down on the chart. So this is right here. I actually remember that. It was about a 20% dip. 20% by most people's definition is a bear market. Ours, we would call that a 20% correction. A bear market, we think, has to look more like this, last for an extended period of time. So that was a blip in the fall of 1998. And my, how it showed up in the technical, certainly up here in the cyclical stuff, foreign, bonds were looking very good technically at that point. So this was a pretty ominous picture. Question would be, is that volatility to respect or volatility to ignore? Certainly a technician would say, respect the heck out of it, maybe get defensive, yada, yada. But when you look over here at the economic data, consumer, which is 2/3 of the U.S. economy, consumption that is, was looking very strong. Businesses were looking okay. The inflation was okay. Financial stress indicators were beginning to roll over. A lot of them had to do with the equity markets, that's going to put some, and the debt markets, that's going to put some strain on these indicators. But the rest of it didn't tell us that we need to get exceedingly cautious at that point. So moving forward, How about here? How about at the peak? August 11th of 2000. Now the market had bounced off of that really nicely and had a really good run. And the technicals, of course, looked pretty good. Therefore, I mean, there was some, we could see on a sector by sector basis, you could begin to see some breakdowns. But the S&P 500 itself was looking pretty good, although you can see the monthly MACD was giving a signal here, but the slope was up. So often those have been false when we have an upward slope. However, look what's happening with the economic data. The consumer, bunch of red is beginning to show. Businesses really beginning to roll over in terms of the economic data. Inflation was troublesome at that point, and the financial stress indicators were getting very ugly relative to where they've been. This is something to pay very close attention to. As the market began to roll over, smart investors or traders would pay to get defensive with this kind of economic background, and sure enough, we ended up having a doozy of a recession and downturn as the tech bubble happened to burst. So how about September 21, 2001? Here we are, big decline, big drop. I would imagine traders might have got excited and think, you know, that may have been capitulation. Now let's watch the market go higher. So of course the technicals were basically very ugly because of that big downdraft, but the economic data really wasn't giving us much hope, if any. Homebuilder confidence happened to be up for whatever reason at that point. The inflation indicators were looking a bit better, but the financial stress indexes were still looking quite ugly. So this would not have been something to get excited about here and rush back in with that kind of economic backdrop. How about March of 2003, when the market actually finally bottomed, March 31st? So here we have an exceedingly ugly technical picture because prices, of course, are just getting blown out below. But take a look over here to the left, the economic assessment, the consumer is beginning to look better. The colors, the charts are beginning to brighten up. Business sentiment, not so good. This is the purchasing managers indexes for large services and manufacturing companies, and small businesses were still profoundly pessimistic. However, industrial production was picking up. Corporate financing gap, that would be earnings relative to non-residential investment, was looking good. Corporate and industrial loans were beginning to pick up. Companies were not issuing much debt, but the rates were good. Truck tonnage was beginning to pick up and so forth. Caterpillar was actually seeing global sales increases for the first time in a while. Inflation was looking good, and the financial stress indicators got better markedly. Sure enough, that happened to be where the market bottomed. So here's the technicals continuing to just bleed very, very red. But here's the economy. So again, the opposite of where we are here. Here we are looking for perhaps an opportunity to make long positions there. And as you can see here, it paid off quite nicely. March of 2008, fast forwarding a bit. So here we had the market, it had peaked, it had gone up, and it was beginning to come back a bit here. I suspect right about that time, a lot of people were saying, hey, you know, we've had a washout, we've had a nice correction. Look, now we're getting trends beginning to improve, starting to see some improvement here on the shorter term indicators, market moving above the 50-day moving averages for the S&P and many other sectors. Still overall a pretty bearish picture, but look over here to the left. That is about as ugly economically as it gets. No, absolutely not. Not something to get very excited about with that kind of economic backdrop. And we had the worst recession since the Great Depression. How about 2011? So we came out of that, and here we are after just a horrendous recession and bear market, correcting 10% correction, 10+% in 2011. Technicals were beginning to show some stress here in the short term, although the longer term trend indicators were very much intact. So technically the long term trends hadn't rolled over, and we still had an okay picture. The consumer mortgage apps were down a bit, consumer confidence was down, home builder confidence was down. Other than that, not bad. Business indicators were looking pretty good. The stress indexes, we did have swap spreads beginning to decline, high yield credit spreads. There was some fear that companies would not be able to make those debt payments, particularly the ones with suspect credit ratings. The Kansas City Fed Financial Stress Index is very sensitive to market dynamics, but the rest of it was relatively okay. So now on August 9, 2011, it doesn't look here like we should abandon ship because we have a 10% correction. How about November 16, 2012? So we came out of that correction pretty nicely, came back, blew through all the moving averages, starting to get suspect right in here. All the longer term trends look pretty much intact, but the economy looks really, really good, with a couple of exceptions that had to do with small business sentiments. And now this right here would be definitely volatility to ignore, and quite frankly, based both on the technicals and on the underlying macro fundamentals. How about August 2015? First 10% correction in 11. That's a very, very long stretch, unusually long. Got the technicals beginning to break down. We have a sell signal on the moving average convergence divergence, although we still had an upslope in the 200-day moving average. Had to be scary. Substantial drop in the fall of 2015. But look at the economic backdrop. Still generally good. We had some concerns as oil prices had come down. We saw a lot of defaults in those marginal energy producers, but the rest of the industries actually looked pretty good from a high yield credit spread standpoint. But all in all, certainly nothing to fade if you're looking at the economics. So how about right here? After we had that correction, then we suffered the worst start to a year in history, believe it or not, in 2016. What did it look like right here as the market bottomed and then finally bounced out of this long-term consolidation box? Well, technically, it looked like a disaster. Bonds were looking up, gold was looking better and so forth, but stocks just looked really, really abysmal at that point technically. However, remember, the consumer, 2/3 of the U.S. economy, was looking very good at the time. Businesses, with the exception of small business sentiment and industrial production, was rolling over a bit right there. And then Caterpillar hadn't been seeing global sales for quite some time, but otherwise, things were looking okay. Inflation was okay. The financial stress indexes certainly were going to see some after this, but not a complete rolling over like I've showed you at other times. So now, this here, despite the really tough technicals and some red here in the economy, not enough here to say that we are likely rolling into the next bear market, because generally speaking, folks, bear markets need recessions, and we did not have much, if any, recession risk at that time. And sure enough, here we are bouncing out of that. And just again, in closing, let me show you this week's chart, having shown you all that historically. Again, despite the headlines, despite North Korea, despite other things that we're all too aware of, the fundamental backdrop, economically speaking, looks very strong for the market going forward. And quite frankly, from a long-term trend standpoint, looks good for the market as well. Near term, we're seeing this because of the recent volatility, which I think is the norm. Of course, we see lots of volatility throughout all years in the market. Having said all that, it's all subject to change, and it can begin changing tomorrow. That's why we keep a close watch on the data that we think is important. And what I just showed you today is just a look back at using a lot of what we review and monitor and follow up on to essentially gauge our view of the market. And what we think is important right now is telling us, quite frankly, to stay the course. I'll say it again, that's all subject to change, and of course we'll keep you updated on a regular basis. Thank you as always for watching and listening. Have a wonderful weekend, and I'll talk to you again soon. Bye-bye.